All right, so first thing we're going to do is go over 18-5. We didn't go over this before. Let's spend some time going through it. You will need to know how to journalize a lot of these different things that are in the past. There are, just as a hint, there are no problems specifically in chapter 20. A majority of them are from 21. So as you're looking and preparing, look at the cash flows, those type of things, the stuff we just finished up. The majority of the questions, the problems will come out this chapter here. That's our work on a problem because that problem consists of a couple of those.
Dr. Sutton, can I borrow those papers?
Oh, yeah. All right, so 18-5. And this problem, what we're going to do is we're going to take a look at the issuance of shares and non-cash consolidation there. So during the first year of operations, Eastern Data Links Corporation entered into the following transactions related to stockholders' equity. The articles of the corporation authorized the issue of 8 million common shares to Dawn Bar and 1 million preferred at $50 per bar. So they sold 2 million of common stock for $9 per share. This is similar to one that we've done in the past. I don't know the exact number that we did. We did one similar to this. So February 12th was a journal entry that we would have to put in there. Cash. And so we have cash. So it's 18 million, which is 9 times 2. Is that what it is? Oh, no, it's 18. Is it? Okay. So 18, and we have common stock here. The bar is 2, as I said, and then you have your paid capital addition. Oh, it's paid capital. Yes, it's a bar. It'll be your 16. All right, so questions on that portion there? I'll give you a moment to work on the next part of that, which reads, issued 13th, issued 40,000 common shares to all attorneys in exchange for legal services. Okay, so what would you do there? Anybody thoughts there? Legal expenses? Yep. We have legal expenses. And how much was that? 40,000 shares. So how much is that? So $9 a share for 1,000. So 360,000. Right? All right. So we have common stock here. Dollar par, so we have 40,000. And then paid in capital, I'm just going to put PIC as a par. You see me do that. PIC means paid in capital. And that's access there. Now, remember, this one doesn't tell us how much it is, but the $9, it doesn't tell us. We can assume it since the day before it was $9, it would be at $9. All right, so on the 13th also, we sold 80,000 of its common shares and 4,000 preferred shares for a total of 945,000. All right. Kind of figure all that out. So remember, it's 945. That's the cash that we're getting in. And then figure out, when that you have the common stock, and then your pick for the common stock. And then you have your preferred. And then your additional pick too, for that one. So how many shares do we sell common stock? 80,000, so that's $80,000. And if we sold 80, that's 8 times 8. What's that? It would be 720 is the total.
Oh, right.
But remember, the $1 came out for the common, so the excess is $8. 8 times 80,000. So it'd be 640. That's all right. Okay. That's 640 here. And how many shares do we have here in the preferred? How much was that? 4,000. Okay, so 4,000 shares. So that was $50 a share. So 200,000.
Yeah.
And then what is the excess of par there? I guess it was the rest. So that's 920, that's 945, so I get 25,000. So that's how you do each of those. Or I'm going to come over here and do right over here, the last portion here. So this is November. So issued 380,000 of his common shares in exchange for equipment for which the cash price was known to be 3.688 million. All right. So we get plant, property, equipment. That cost us what we received. That there, right? 3,688,000. All right, so we issued common stock. Almost 380,000 shares. So the rest of that would then be paid in capital. Oh, 300, yeah, you're right. Gotcha, I see that. What's that? 308, okay. All right, so questions on how we walk through all that? You guys feel pretty good? All right, so the next one we're going to do here is 19-16. Give you guys a moment to finish up there, and we'll turn to that page. That page is 1186 at the bottom of the page there. All right. So remember back in that chapter when we did it at EPS, diluted shares, and all that. So we'll go back to that. So we're going to be working on that in this problem here, where you're going to figure out what the EPS is, what the basic EPS, and then the diluted EPS. So remember the differences there as you're walking through this. Yeah, remember you get a note card. So make sure you fill that thing out.
What's 5 by 8?
What's that?
Is it 5 by 8?
size. I don't know. Nobody has 5x8. Just write really small. Okay, so this problem here, let me read through it here. Just on January 31st, 2012, Moncler Inc. had a 200 million shares of common stock and 3 million shares of 9%, $100,000 par value cumulative preferred stock issued and outstanding. So remember that's cumulative preferred. On March 1st, 2013, we purchased 24 million shares of common stock at the Treasury as treasury stock, and then they issued 5% common stock dividend on July 1st. 4 million shares were sold on October 1st, and net income for the year was 150 million. So what we're going to do is figure out all this information. So we need to figure out what the basic and diluted earnings per share is for 2013. Now remember what the equation is. You guys remember what that is? I'm going to erase this here. What's the EPS equation? I know so long ago. Earnings per share, right? So how much money we made, which is net income. We're going to take away our preferred dividends. And then we're going to go all over outstanding shares. All right, so that's our EPS. Now the diluted, remember, is anything that are out there that are options. That can change all of those things. So the diluted typically will figure in here, the outstanding shares, remember, because they could convert to bonds. If there was, I can't remember what I said on that one, but there's a convertible bonds or anything like that that can be converted to change that. All right, so I'll give you a moment to kind of begin to figure that out. Start with that net income, figure out what the preferred shares are. Now, as you read through that, remember what's going to change is our outstanding stock. We'll start here. This is basic. We had 150 million, right? Then what was our dividends for preferred? So yeah, it's 9%, $100, so that's $9 per share, right? Because we're doing 9% of 100. So 9% of 100, so 9% times 100, it gives us $9 per share. How many shares do we have outstanding? How much was it?
3 million?
Yeah, 3 million, that sounds right. So 3 million times 9 is 27. All right, so we have 27 here. That's what we're taking away. All right, we started off, I think, with 200 million. 200 shares. So, okay. So we have 200 million shares. Now, we did have a stock dividend you mentioned just before. Remember you said 5%?
Yes.
So we're going to take that times 1.05, excuse me. Okay? Because we're going to increase that because that's out there. All right. Now we're going to take a look at some of the other things that go with this. Let's see here. In the middle there, it says on March 1st, Benacar purchased 24 million shares of its common stock as treasury stock. Grab that door. So they purchased back in. So we took away stock that's out there, right? So we're gonna take away 24 million shares, but we did that on what date? Let's see, we'll get. Was that March?
March 1st.
March 1st, okay, so we took it on March 1st, so that means I have 10 months left, right? Because I used up January and I used up February. I'm also going to take that, multiply that by 1.052, because remember that dividend. But I don't want to do it for the full amount because we only had it for a limited amount of time there, so that's why I'm doing that. All right. Now, when was that dividend given out?
July 1st.
Was that May 1st?
July 1st.
July 1st. So anything after July 1st, we don't worry about the dividend, okay? So just be aware of that. So what else do we have here? So we have 4 million shares, near the bottom of that first paragraph, says 4 million treasury shares were sold on October 1st. So since we sold those, we're going to have to figure out what they are. So we have the 4. So we're going to add those back in because now we've increased it. So we have that. We don't have to worry about the 1.05 because that was afterwards, after we'd already calculated it. What, I said October?
October.
So I have 3 months left in the year, right? October, November, December. So those 3 months, so 3/12. All right, what else do we need to do? Anything else in there? Yes.
What did you print for again?
So in the second paragraph, or the first paragraph, the second to last sentence says 4 million treasury shares were sold on October 1st. So that we purchased back in, we said put it back out there.
Okay. I see.
All right, lastly, let's take a look here and see what we've got. Anything else? Oh, there we go. We have that's an option. Let's see, right sizable is that.
Did you use that information for the diluted?
Yeah, we're gonna use some of this information for diluted here. All right, so we do have that 30 million that's exercisable. Since it's actually exercisable at that point in time, we are going to include that in there, okay? So you see the 30 million there, that's the second paragraph, second line. So the options are exercisable as of September 13, 2012. 30 million common shares and an exercise price of 56. We don't really care too much on that, what the price is. We care about the 30 million. So we're going to figure out what 30, we're going to add that 30 million in there. So we have the 30 million. How many months is that? We're going to include the full month. So that would be September, October, November, December, 4 months. So 4/12. All right. I'll let you guys start figuring this out here. So it's 123 over. All right, but what'd you guys come up with here? Everybody have that? Oh, what's the bottom number here? Oh, you got it?
200?
200, okay. So if that's 200, that gives us 61.5?
Yeah.
Okay, all right, yeah. Yeah. 62. No, 62. 62 cents. We'll round up to it. All right. So that is your basic EPS. Now let's do the diluted. Same stuff on top. And the same stuff down here, except we have to make a couple changes here. You still have this here. This is all still the same, right? No change. Let's see here. Is that 4? Is that 4? Oh, yeah. That's right. Sounds good. All right. Now we got to figure out some other things here. So remember in there where we have to figure out how many millions of shares we have that are available out there for the exercise, how much it would cost us. Remember that? Because sometimes we can't purchase it for what we had it out there for. All right, so what we need for this is, look at this over here. We need 30 million shares, right? So we have 30 million shares that we need to purchase. All right, so we have 30 million shares. What's the cost of that? I think we gave it to us somewhere in there. $56. Okay, so how much does that come up to? How much do we need then? So it's 56 times 30.
1,608.
1,608, okay. All right, so that's what we need right there. So that's a million shares that we need, the amount of money we need. Now, how much is the average market price right now? We've got to purchase these back in.
So it's
70, you said? Yeah, so we divide that by 70. So know how to do this mark here. And figure out how many, was that equal there? 24? Okay. So then what we're gonna do here is take the 30 minus the 24, because then we actually need six additional ones, right? And then we're also going to multiply that by 8 over 12 the other way. Remember, it goes the other way. And then we'll add in our last one here that we already have. So this is the diluted that we would have to figure out here. So remember, this portion of it, this is the difference here. And then figure all out what that is. So we know the top is 123. That hasn't changed. So you have the bottom, 204. 204, that's probably roughly around 61 cents or 60 cents? 60? Okay. Just going off of, let's go to that one. All right. Have I totally lost you yet? So you will see a problem like this next.
So you can pretty much say, just like the rule, like that 8 12s and that 4 12s, the second part should add together, or is it just?
Yeah, we'll have to get it, this is the first half of the year, second half of the year, yes. So, yeah. All right, so any questions on that? That will definitely be there on the test. Know this portion of how to get that for the diluted. This is basically how much we have to purchase in to give them what they need. And we have that 6 million different things that we have to add into it additionally. All right. So let's look at problem 21-6. This won't be terrible. I did something like this the other day. All right, so this is on page 1325. Now basically it's walking through what we did before. So what we did before was we took a look at the changes. In the income statement. Remember the changes there that we did? Or the case statement of cash flows? You guys okay for me to erase this? All right. All right, so let's walk through this. All right, so take a look at this problem here. We received a certain amount of cash in. We have sales of 150, right? That's what it's asking us to do. So in the problem, it asks us cash received from customers during the reporting period. So we have sales of 150. So sales revenue here. That's 150. What was our change in our accounts receivable? Don't put AR here. Was that an increase or a decrease? Decrease, so we would credit that for how much?
5.
5, okay. And then that's cash we received would be 155. That's how you would write that journal entry here. The reason I'm having you do this is in this problem, you'll see little portions of this problem in the test in different parts. So you might have to do one journal entry like this, maybe another one, a different one, something like that. So that's why we're kind of walking through it together here. So the cash, the reason we receive more cash is that accounts receivable went down. So that means we collected more money. We also collected all that we had in our sales revenue. Therefore, that's why the cash is higher. All right. Next part of the problem says cash paid to suppliers of goods during the reporting period. So we'll start with our COGS, which is 90, right? Now, do we have a change in inventory? We have an increase in inventory there. So if we have an increase in our inventory, our journal entry would then be inventory here. And we're going to add 6 to that, right? Because we've increased the inventory. It's just a summary entry here. So next thing is we have any accounts payable changes? Accounts payable?
Increase
How
by
much?
9.
Decrease by 9?
Increase.
Increase by 9? Okay. So if it's an increase, we're going to credit it. Increase by 9. And then to figure out what our cash is just figure all that stuff out. Make sure they balance. So that would be 87. So questions how I came up with these two at all? So that remember, when you look at the cost of goods sold, write that down, put it on your note card. that what it affects is here inventory and accounts payable. You gotta take a look at both of those areas there. Okay, so let's go to C now. So on C, we have cash paid to employees during the reporting period. So I need to figure out what cash is paid to employees here. So, what will we have as our debit?
Salary.
Yep, salaries expense. How much is that? Get to that here in just a moment. What else do we have? Some we owe them, so it's gonna be salaries payable. And then we have cash. All right, so what's our salaries expense? 20? All right. And we have 20. What's our change in salaries payable?
Increased by 3.
Increased by 3, therefore leaving us with 17 in cash. That's what we paid out. Yeah, we'll try to put this over here. D. All right, so with D, we have cash paid for interest during the reporting period. So we have cash paid for interest, we have interest expense. We'll go interest expense here. All right. How much was that? 6, okay. Now remember what we have there, as a part of that, we have things we're paying interest on, so we may have a discount. So I think it's called a discount on EP, loans payable. What's the change there? Decreased by 3. Okay. And then I'll give these as cash of 3. All right, we're near the end. So cash paid for insurance during the reporting period. Again, let's do that here. That's insurance, right? Expense. We have prepaid insurance, and then we have cash. So what's our prepaid insurance expense there that we have? Let me show. 12. What's our prepaid change? 2. Is that a
Is it decreased?
decreased it, so we credit, okay. And then we have a cash of 10. Make that balance out. And then finally, cash paid for income taxes during the reporting year. So we have income tax expense. And then we have income tax payable. And cash. What was our expense there? Oops. Cash is payable. What's our income tax expense? 13. All right. What was our income tax payable? 6. Decrease. That means we took some of it out of there, so that means we're crediting that, and that means our cash is 7. All right, I'll let you kind of take a look at this. So the last part of this, I'm going to erase this here, so I can work over here. We're going to do our statement of cash flows on that. So we're going to take our statement of cash flows and figure out what that is. Now, what are we using here? We're using the direct method. Remember, you see the direct method, so it's a little different here. So what we start with in the direct method is the cash received from customers. So how much we received there? How much we received from customers there? It's right here. It's the first one we did. 155. That was when we were figuring it out. All right, so we have 155. Then what's next here? cash paid to suppliers. All right. How much do we pay? 87. I'm going to take away 87. Okay. Next one we did was cash paid to employees. That was right here. That's it, 17. And the next one there is cash paid to for interest. Interest. You guys know what I mean there, right? Good, lazy. And that was 3. Cash paid for insurance. That is 10 we paid. And then cash paid for income taxes. That is 7. So what do we have there? 31. So that's our from operating activity. And cash flows from operating activity. All right, so questions on all that? So using the direct method, this is what you would have to do is walking through that. You may do a little portion of this in the problem, you may do portions of this in the problem. So I just want you to see all of that. Some questions on any of that stuff? All right, I'll give you a moment. We're going to work on another problem. I'm going to do one of the ones from the multiple choice area, which is exercise 19-2. We'll slide back to that one. I'll leave that up there for a few moments.
What page is that on?
1184. Everyone that gets to that page, just kind of put it together here. And so you will see this in some of the problems, this one here, some of the things that we'll do. All right, so 19-2, on January 1st, 2013, VKI Corporation awarded $12 million of its $1 par common shares to key personnel subject to forfeiture if the employment is terminated within 3 years. On the grant date, the shares have a market price of $2.50. So when determine the total compensation costs pertaining to restricted shares. All right. I'm going to erase this here. So what do we do to figure out what the share price, the total would be there? Basically what we're going to do, 19-2, is we're going to take the amount of shares that we have that they can exercise, right? And multiply it by the price. So our fair value for this is $250. That's our fair value for the shares. We have our shares. How much were those? How many of those do we have? 12 million. Okay. What does that come out to be? We got some 30. 30 you said? All right, so 30 million. So it's 30 million. All right, so questions how we got that? Pretty simple. Next question, prepare the journal entry, appropriate journal entry to record the award of restricted shares on January 1st, 2013. Did we award anything? They didn't award anything yet. We have that potential out there. We haven't given it to them yet until the grant date. So there is no journal entry as a part of that. Okay. So then what we're going to do is next we're going to move on. So there's no journal entry that we make until the point that we're going to actually do that. Because they haven't. Because if they left tomorrow, remember what happens. All right, so number 3, prepare the appropriate journal entry to record the compensation expense on December 31st, 2013. So remember, we're going to take it over 3 years. We're going to take this over 3 years. So we have compensation expense. So B is no entry. C, we have compensation expense. And how much was that? You're going to take the 30 million divided by the 3 years. So that gives us 10 mil. Questions how I came up with that? Because we're going to spread that over the 3 years, right? Now, the D is the same thing here, and E is the same thing here because it asks us for 14, it asks us for 15. Well, it's the same entry that we're making. So if you see there, number 3, 4, 5 says the 14 and 15, so it's the same. So I'm going to slide down to 6, which is the last one here. We prepare the appropriate journal entry to record the lifting of restrictions on the shares at December 31st, 2015. So once we have taken away that restriction there, we're going to remove that restriction here. So we have that pick, 6 or 5, E, F. Okay, so we have 30 of that, right? We have pick restricted stock. We had 3 of these for 3 years. So that's where I came up with the 30 here for this. Okay? All right, so now we have common stock, and then we got to figure out how much it is when we have that. Then pick excess of par. What's that?
That common stock with 12 million.
Yeah, it was 12 million shares, right? $1 par? Perfect. That will give us a pick of 18. This is excess of par. Questions on that one? Pretty easy so far. You guys gonna ace this test? All right, I hope so. I'm gonna have to reevaluate here. All right, we've got a couple more minutes, so I'm gonna work on one more problem. Let's do one real quick here. It's a brief exercise 20-5. So it's BE 20-5. So it should be a quick one here. I'm trying to give you as much help as I can. Prepare for it. That is on page 1232. But we did this one similar to this. I think we did this one already. Yeah, we did do this one. Forget that one then. There's 4. All right, switching gears then. So let's do BE 21-4. Sorry about that. So we've already done that. I decided to do it anyways. Let me write down my notes. right, so this company, salaries expense was 17 million. What is the amount of cash paid to the employees during the reporting period if the salaries payable increased by 3 million? Pretty easy to do here. Prepare a summary, kind of like we did back in the other problem. Entry that represents the effects of the salary expense incurred and paid during the reporting year. All right, so what will we do there? I'll give you guys a moment to figure that one out, and then I'll put it up there. Shut. Pretty easy. So what will we get? Remember, it's going to be salary expense, salaries payable, and cash. So how much was paid out for salaries? I'm thinking 17 was the expense or paid out? 17 is the expense, okay. So 17 is the expense. What was the change in salaries payable? 3 increase. So we'll, since it's we'll credit it, and that means our cash out was 14, right? All right. You guys feel pretty comfortable with stuff? All right, so Monday. Does anybody have an 8 a.m. exam? Okay, so I'll give you guys. I will be available before the test if you guys have questions. I'm available this afternoon if you guys have questions. It's about 3:30 I have a meeting, and I have to run through after that, so I won't be here the rest of the day after that. But if you have any questions or anything you want to go over, you're welcome to stop by and see me. Otherwise, thank you for all your hard work in this class. I appreciate it. And we'll see you on Monday for the last day. Let me turn that off.
How do you turn it off?
There's a button, or just close the thing. Just close it, turn it off.
Oh.